first quarter of 2017 can probably be characterised as a steady as she goes quarter. Most assets went up by a small amount, single-digit returns were normal, and this was quite a different start to the year compared to many of the geopolitical and rise of populism happenings in 2016. It's quite amazing that since the 1st of April 2016, equity markets have produced around 20% returns, and bond markets have generally retreated over the last 6 months. All these continued in quarter one, with the one surprise being the change and the rise to prominence again of the emerging market equity and currency markets. In November, post the election of President Trump, many had been concerned about global trade impacts and had sold off both emerging market equities and currencies like the Mexican peso. In this particular quarter, the Mexican peso and the equity market was the best performing of the multi-asset universe. Bonds continued to retreat, producing negative returns for quarter one in a similar fashion to quarter four 2016. But we still stand at a point where many asset classes are seen to be expensive on long-term valuation. The main changes were in the Japan equity market, where we felt that the strong return to favour in late 2016 warranted a trimming of those views. And the new exposure that we brought into the portfolio was a global healthcare sector view. This has been driven by, we feel, healthcare companies, particularly in the US, but also in Europe, providing very strong, stable balance sheets, strong returns on equity and capital, but being valued below their technology and financial peers. So we have brought into most portfolios in the multi-asset sphere an exposure either via an ETF or a direct equity portfolio. Well, all our multi-asset portfolios have demonstrated since inception their ability to meet their long-term objectives with a reduced chance of drawdown in the case of volatility. We continue with this philosophy and approach. Given the lack of volatility so far in 2017, we haven't changed portfolios that much, but we continue to focus on having high conviction, non-traditional exposures like emerging market equities and healthcare, coupled with a defensive approach, holding cash, awaiting an opportunity to buy quality assets at more attractive valuations in future. Putting these two together, we are expecting volatility in the future. We think that the combination of expensive asset classes on a long-term basis, equities, bonds, real estate, infrastructure, coupled with a number of geopolitical and election results to come in 2017, means that we are very well placed to seek those attractive opportunities and to act with high conviction when we do. Doing this going forward, we expect to be able to meet those CPI plus objectives, and on behalf of our investors, minimise drawdown or loss of capital in difficult times.